On this morning's Ag Issues program, as always, a pleasure to bring on to the program Roger McEowen, who is the professor of agricultural law and taxation at the Washburn University School of Law, and weekday mornings at about 5:35 or so, you can hear his agricultural law and tax reports as well as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg.
Hopefully you got some of this beneficial moisture over the weekend?
Some is an understatement. I'm not quite sure. I don't have a rain gauge out at my place, so I'm not sure how much fell, but it was plentiful, I tell you.
All right. Hey, let's get to it. As we mentioned at the start of the program today, talking about planning for changes to the federal estate and gift tax system, is it safe to say, Roger, that you have received, I don't know what the term is, a lot of inquiries on what Congress might do to the federal estate and gift tax laws?
Yeah, that's a safe way to put it. That's for sure. There isn't a day that goes by, and hasn't been since November, that I probably haven't fielded at least 2 calls or emails every single day from farmers, and particularly farm wives, concerned about what might happen if and primarily what they're concerned about is if that exemption from estate tax goes down, which is currently sitting at $11.7 million per person. And if that goes down significantly, then we do have some issues, some big issues for a lot more farms and ranches than we presently have. And so that's the concern. Can we keep our family business in the family from generation to generation? Do we need to sell some assets? What do we need to do in terms of revising an existing plan? So lots of questions that are out there right now.
And you go back to the exclusion amounts as far as for the transfer tax. This goes back to, I think, 2017, correct me if I'm wrong on that, on the Tax Cuts and Jobs Act?
Yeah, it was basically doubled starting for years after 2017 from $5 million to $10 million indexed for inflation, took it to about $11.18 million, and then it's been adjusted for inflation ever since then. And currently, it's sitting at $11.7 million for deaths in 2021, as well as gifts made this year. And that will continue under present law through 2025. And then in 2026, if Congress does nothing from here on out until that time, it goes back to that $5 million level, but indexed for inflation from 2017. So a lot of us think that if nothing changes, it would fall back in 2026 to somewhere around 7 million is probably where it would be at, between 6 and 7 million. But the talk is that we may not get to 2026 without a change before then.
Well, let's talk about the proposed legislation. And I know, shock and surprise, Bernie Sanders proposed, Senate Bill 994.
Yeah, that's the so-called 99.5% Act. And there's really 2 of these out there. There's one in the House and one in the Senate. They kind of mirror each other, but there are differences. I think for our purposes today, we'll just talk about the Senate one, the 99.5% Act. It's known as Senate Bill 994. So if anybody wants to look it up, that's where you can find it. And the proposal would set the federal gift tax exemption at $1 million with no indexing, and it would set the federal estate tax exemption at $3.5 million, as well as generation skipping transfer tax. That's not something that I plan on getting into this morning, but if you want to leave the property to your grandkids and skip your kids, then there's a special tax for you too. And actually, there's a famous Kansas case on that going back about 25 years ago. But that exemption would be $3.5 million. So $1 million on gifts, $3.5 million on estates, and it would retain the current rules concerning portability between spouses of the unused exclusion amount. So what that means is at the death of the first spouse, if the estate wasn't large enough to use what would be the $3.5 million exemption, any unused amount would port over to the surviving spouse and be added to the surviving spouse's exemption that spouse already has at the time of death. Now, we have that under current law. it's not automatic that it ports over. You have to file a federal estate tax return in the deceased first spouse's estate to get it to port over, but that would be retained under Sanders' bill.
Now, quote unquote, this isn't new because there's been similar things that have been proposed in the recent past.
Well, if you go back before the Trump administration, the answer is yes. There was talk about reducing it. And really, if you look historically at this, the exemption's never gone down. I remember when I first started practicing almost 30 years ago in Nebraska, we were working with a $600,000 exemption. And I look back on this, and of course, I tell my students this, and after explaining what the current rules are, we're sitting at 11.7 million, and they can't believe that it was 600,000. Of course, none of them were around in 30 years ago, but estate planning for farms and ranches even 30 years ago, 600,000 was pretty easy to exceed, and so it affected many farms and ranches 30 years ago, and then it steadily increased. I remember when it went to $1 million, then it went to $1.5 million, and it gradually kept going up, and it got to that $5 million level, and then Trump administration came in and doubled it and indexed it for inflation and just pretty much eliminated the issue for the vast majority of farms and ranches. We got it down into just, maybe a couple thousand farm and ranch estates nationwide that would have the potential of being subject to federal estate tax. And so it really kind of took estate tax planning off of the table for farm and ranch families. Now, there are a few, certainly, and there are some of those in Kansas that are in the $20, $30, $40 million range, and primarily those are cattle operations in western Kansas. But it doesn't affect very many. But if it goes back down to that, what the talk is, in the Sanders bill, $3.5 million, that's going to pick up a tremendous number of farms and ranches. If you just look at USDA data, Greg, I had another article that I posted sometime, recently in the last month or so, talking about the USDA data. Average farm size is about 450 acres nationwide, bigger than that in Kansas, and average land value is about $3,000 per acre nationwide, a little less than that in Kansas. That's all classes of land: irrigated, non-irrigated, pasture, cropland. So you multiply those together, you're about roughly $1.5 million just in land value, and then you add in machinery, you add in the home, you add in insurance, you add in livestock, you add in all the other assets. It's the typical farm or ranch operation is going to be pretty close to that $3.5 million amount, and so that would require a lot of work in terms of estate planning for the typical farm and ranch operation to avoid that estate tax so that you don't have to lose value, sell assets off to pay that tax at death. And particularly that's important if you want to keep the operation intact and pass it on to the next generation so that they can have a viable farming and ranching operation from generation to generation. So, moving it to $3.5 million, that really creates some concerns, and then that brings estate planning back in vogue, so to speak.
Yeah, and I think you just mentioned that about that special use valuation. That's still, I would think, pretty viable as far as for your tax planning.
Yeah, special use valuation is a technique where we can value the ag land in a decedent's estate at its value for agricultural purposes rather than its fair market value. And so that was put in back in 1976, and Senator Dole was one of the senators that was instrumental in getting that in the law. And the reason for that was primarily farmland that was near, say, Kansas City, Wichita, Topeka, an urban area, and it doesn't have to be a big city, but any type of area where there's potential commercial development, it was driving up that land value. And if the family wanted to keep the farming operation in the family and as a viable operating farm, it was getting that value up in the decedent's estate when the farmer died. and creating an undue tax burden. So now we have, since 1976, the ability to elect special use valuation to value that land at its ag value in the estate rather than its fair market value for development purposes, for example. And we can drop out $1.18 million in value this year for deaths this year. So if I've got say a $4 million farm estate and the exemption goes to $3.5 million, I can avoid the estate tax by getting that $4 million down under $3 million by making that election. Now it has to stay in the family, so it has to pass to what's known as a qualified heir, and it has to continue to be farm. It can't be cash lease. There's a whole bunch of restrictions, and when I say a whole bunch, I mean a whole bunch. This is very, very complex stuff, but that rule would stay in place. And that would be necessary, indeed, if that exemption does collapse down to $3.5 million.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us. And our discussion today focuses on the planning for changes to the federal estate and gift tax system. And Roger, we just mentioned about special use valuation. How does this going to look as far as conservation easements are concerned?
Well, under current law, land that's subject to a conservation easement can be excluded from the estate up to $500,000 in value. What the Sanders bill does is increase that amount to $2 million. So there is a favorable provision if you want to leave your estate to charity or to put it in a conservation easement, and it also increases the maximum percentage of the land that can be excluded from up to 40%, from the current 40% to 60%. Now there is a 100% rule for agricultural land that would be retained. So that's one thing that's out there, but a lot of people. A lot of farmers and ranchers say, I don't want to have conservation easement restrictions put on my property. I don't want the federal government to have that type of control over my land. So I'm not sure how many farmers and ranchers will find that acceptable. There may be pieces of land on which an easement could be placed, but it has to meet specific rules to be eligible. So nice provision. Not sure how many in ag are going to want to use that one.
What about Grantor Trust?
Well, here's really where the rub is in terms of a lot of trust planning. Grantor Trust, the revocable living trust, as well as the irrevocable trust. To make a long story short, the Sanders bill and a companion bill that's out there would really eliminate a lot of the planning that we do with trusts and would cause that property, particularly the irrevocable trust approach, to be included in the gross estate, the property that's in those types of trusts, to be included in the gross estate at death. So that's pretty difficult too. And then, we've always liked to use a lot of valuation discounting techniques in ag. We create entities, work mom and dad into a minority position at the time they die, so that we get discounts when we gift minority interests of stock or membership interest in LLC to the kids, and then when mom and dad die, they own less than a control interest in the entity. We take another discount there. The Sanders bill really eliminates those techniques, so we're not going to be able to get those valuation discounts. They're basically gone, except for assets that are used in the active conduct of a trade or business. So if it is an active business asset compared to one that's not actively used in the business, we could still take a discount. Now, that's going to require a lot of work to set the estate up correctly so that we can get the discount for an active business interest. But it does limit the use of valuation discount techniques.
What about on the grantor side, once again, looking at grantor retained, so for on annuity trusts?
Yeah, the grats and gruts are very useful techniques. Those are done in succession planning concepts for some families. It's a technique that allows you to freeze the value of the transferred assets that are contained in that trust, while at the same time we give the grantor cash flow stream for a certain time period, say 10 years or whatever the case might be, set it up so that they get that stream of income out of it for what we project to be a life expectancy. And I've written about those in numerous places on my blog in the past. But basically, the Standards Bill essentially eliminates that planning strategy. It imposes a minimum 10-year term and a maximum term that's tied to the life expectancy of the annuitant plus 10 years. Well, long story short, those two restrictions pretty much wipe out the planning associated with grantor retained annuity trusts. We're not going to be able to use those, and that's just another tool that's removed from the toolbox. And we'd like to have as many estate planning tools in that toolbox that we can possibly have.
I want to get down to, before we run out of time, looking at gift tax rule changes as well. What in Senate Bill 994 is going to be changed there?
Yeah, well, I think a way to talk about that quickly is to compare it with what the current rules are. For example, Greg, you could give me $15,000 this year and next year, and I would suggest you do that, and you wouldn't have to pay any gift tax. And of course, the recipient of the gift, me, doesn't have to report it as income. It's a gift. Well, I would suggest, Greg, you do that now because the proposal is for the rule to change. And the Sanders bill specifies that the first $10,000 of gifts made to a person during the calendar year is not to be included in the amount of gifts made during the year. So the 15 goes to 10, and then limited to $20,000 per donor. So they're going to keep track of this, and then once you get to $20,000, then it becomes a taxable gift rather than $15,000 every year. And so that's a major change. And, as we talk about all of these, I don't think the bill will pass as it is written. There will be changes that will be made to it. And I think that's one of those on the gift tax side. See, they keep the total limit for all gifts made at a million, and then per individual to $20,000, where right now it's $15,000 every year to as many people as you want, not considered to be a taxable gift at all, and not in the computation of the other gifts that count against the exclusion. And then you've got an $11.7 million exclusion that applies to gifts or estates. So that's a massive rule change there with respect to gift tax and a decoupling with the estate tax. So that's a major one. So I go back to what I started with, Greg. If you're going to gift me money, do it now. And I'd gladly accept that.
And if you are a person out there advising a farmer or a rancher, practitioner, I guess this case, advising their client, anything recommended that they should tell them, or how should they approach it when they talk to their client?
Well, after you get past today, because today is the end of the filing season, and a lot of people that are doing estate planning for clients also do tax work for clients. So let them get past today, and maybe give them a couple of weeks to recover from this horrible tax season that we've had. And this is, I'd say, the worst one in 30 years that I've ever been involved with. You need to talk to them saying, are there things that we need to review? We need to look at language that exists in current wills and trusts. We need to just kind of do a survey of where you're at and what the rules might be to see if there are any changes that need to be made. And one of the problems we have on some of these proposed legislation is that it's retroactive in nature. And if that happens, then that takes a lot of planning off of the table. Not everything's retroactive, but some of this could be retroactive. And that raises another question as to whether they can do that. The answer is yes, but it's a more complicated answer than that. But it is time to talk to your practitioner that works on estate planning for you, or if you don't have an estate plan and you might be affected by these changes, it's time to start talking about it.
All right, sounds good. Well, Roger, as always, I appreciate it. And I know, too, one final thing, that you've got some workshops this summer that you're going to cover this in detail as well.
Yeah, I'm going to hit this in detail. I've got 2 national seminars this summer, one in Ohio coming up on June 7 and 8, and one in Missoula, Montana coming up on August 2 and 3. I would encourage, and those can be attended online. You don't have to attend in person. Anybody, particularly this year, that is concerned about the estate planning issues, I would encourage them to attend either in person or online. This is, we haven't had a year like this in recent memory, where there's so many significant possible changes that could be made, and you need to figure out how you can start to line your estate up. And if you're a practitioner, what are the concepts you need to be thinking about on behalf of clients?
All right, sounds good. Roger, as always, I appreciate it. Thank you very much.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law. He's been our guest on the Ag Issues program here on 580 WIBW.